Hi, my name is Lisa Cummings, and today I'm going to share with you some information about a cash balance plan, specifically cash balance plan setup and ongoing costs. Before I share that information with you, I want to provide you with some background about our law firm. Our law firm is Cummings and Cummings.law. Our portal is www.cummings.law. Cummings and Cummings Law is truly a full-service law practice. We assist professionals as well as individuals planning their retirement. We also assist organizations with business transactions and planning retirement benefit programs for their employees. A little bit of information about myself. My name is Lisa Cummings, and I have spent my career working with large organizations in a legal perspective to ensure that their retirement benefit plans are designed cost effectively as well as in accordance with federal law. Now, today, I'd like to share with you some information about setup and ongoing cost for a cash balance plan. If you have a cash balance plan, you must remember the plan is powerful, but it is not free. There is a cost to establishing as well as maintaining a cash balance plan. Cash balance plans can unlock very large retirement contributions and tax deductions for plan participants, especially for organizational owners in their late 40s, 50s, and 60s. But this particular plan is not a set it and forget it. The math and compliance requirements will create real costs. Some costs are one time to establish the plan, and some costs are recurring every single year. In this video, I'll break down the setup process, the ongoing administrative and actuarial cost, and when PBGC premiums may apply so that you can budget properly and avoid surprises. So what all is entailed with the cost of a cash balance plan? Keep in mind, a cash balance plan is truly a defined benefit plan that is in cash balance clothing. A cash balance plan is legally a defined benefit plan, even though it reflects a hypothetical account balance on the statements. That is why a cash balance plan needs formal legal plan documents as well as initial and annual compliance testing. Additionally, annual actuarial certification and funding calculations must occur each year to be compliant with IRS regulations, and annual reporting like the IRS Form 5500 must occur each year. In some cases, PBGC coverage and premiums may also be required. I'll discuss that in more detail in a few moments. So the costs are essentially paying for three separate elements. First, the design and legal compliance. Second, the actuarial calculation and the funding support. And third, the administration and annual reporting. So what are the setup costs? What does it cost to establish a cash balance plan? Well, here's kind of a snapshot of what happens in the first 30 to 90 days. Setup will typically include several concrete steps. First, you need to ensure that a cash balance plan is a good fit for your particular organization. Some organizations do not support establishing a cash balance plan based upon perhaps underlying employee demographics or a short horizon for an eventual payout of that plan. So step one on a cash balance plan is a feasibility analysis. And then if that particular analysis yields the projection that yes, indeed, a cash balance plan would be a good fit for your particular organization, then the plan design that it will occur. This is where your advisor will run projections using your employee census data, owner ages, as well as staff ages, compensation information for every single one of the covered employees who will participate in the plan, staff demographics, and then there will be a proposed design which would fit your goals and would pass required IRS non-discrimination rules. Step 2 would be the plan documents and the adoption. Once the legal design is completed, the actuary has confirmed that this particular design will pass non-discrimination rules, then there would be a legal signing of the plan documents by the organization's president or CEO. And at that point in time, the cash balance plan will be formally adopted. There would then need to be coordination with your payroll department as well as the establishment of the trust. So keep in mind, cash balance plan is funded 100% by the employer, and the employer contributions have to go into a separate, segregated trust. Step 3, and this is where the interesting part begins, is ensuring that your 401k plan employer contributions integrate with your cash balance plan. Many companies choose to combine a cash balance plan to sit alongside of a 401k plan and possibly include a profit sharing contribution component in the 401k plan because the combined design can improve outcomes as well as ensure compliance in the cash balance plan. Step 4, implementation and initial funding strategy. You will establish your funding timing. It can be monthly, quarterly, or as at a minimum annually. And that will be based upon cash flow as well as a funding range, which will be recommended by your actuary. Remember, in a cash balance plan, a setup is not just paperwork. You are paying for truly an undertaking of an engineering design, a compliant design that targets the right benefits and minimizes unpleasant funding surprises later. Here are the categories of the ongoing expenses for a cash balance plan. First, there will be an ongoing third-party administrator, a record keeper, if you will, with compliance support. Your record keeper typically handles the annual production of the participant statements, will be receiving a payroll fee that will reflect eligibility and allocations, and also coordinate a Form 5500 preparation that has to occur each year, and will be the one that keeps track of all of the considerations of the employee demographics as they change, whether it's compensation, age, a mix of employees, addition of new owners, employees. The second bucket of ongoing fees is actuarial fees. The utilization of an actuary in a cash balance program is not optional. Each year, your actuary will typically provide the annual evaluation, the calculation of the minimum required contribution and the maximum deductible range, a certification related to the funding rules, support for funding decisions if the census of your organization or the cash flow changes, and also guidance on how interest crediting will impact future funding. Then, you should also consider an investment management with fiduciary governance. Even though the interest credit, which is defined up front in your plan document, is part of the plan formula, the plan still has actual trust investments. So those employer contributions are sitting inside of a trust, which needs to be actively invested. Many plan sponsors, that's organizations, will use a conservative, liability-aware strategy to reduce volatility of funding, and also an advisor who understands defined benefit plan dynamics. There are fees here along with fiduciary responsibilities. Additionally, there must be an annual filing and a potential audit for your Form 5500, which must, like clockwork, be submitted to the IRS annually. Whether you're also required to have an audit depends upon the size of the plan assets and the number of employees who are covered by that plan. And then you may also experience some miscellaneous compliance costs, such as an ERISA fidelity bond, period plan document, updates, restatements, amendments when business structure or benefits change, or even to retain compliance as IRS regulations will change. So, what are those PBGC premiums? When do they apply and why they matter? PBGC is a governmental entity. The PBGC, which is the Pension Benefit Guaranty Corporation, is a federal agency that insures certain defined benefits plans. It's somewhat like an FDIC that works for banks. So some cash balance plans are required by PBGC rules and some are not. The coverage depends upon factors like the employer type as well as plan characteristics. If the PBGC premium applies, there are typically annual premium filings and a premium payment that can include a flat rate component, in some cases a variable component tied to funding levels. Generally speaking, a cash balance plan will have to pay PBGC premiums unless it is exempt due to A, only covering a sole owner or owners and their spouses, or B, the plan is covered by a professional service employer, such as a law firm, a medical or dentistry practice, and has 25 or fewer participants. So some practical next steps for you to think about. Before you adopt a cash balance plan, first request a feasibility analysis to determine if your particular organization would be a good potential fit for a cash balance plan. Then ask for a written cost outline that estimates one-time setup as well as ongoing annual cost. If you would like to ask me any more additional questions about cash balance plans, feel free to send me an email. Lisa@Cummings.law. Thank you so much for joining us today.